Welcome to our channel. If you're deciding between cash and accrual accounting methods for your business taxes, follow these step-by-step instructions to make the right choice. Step 1. Understand the difference. Cash accounting recognizes income when received and expenses when paid. Accrual accounting records income when earned and expenses when incurred, regardless of payment timing. Step 2. Check if you're required to use accrual accounting. Businesses with average annual gross receipts over $27 million for the past 3 years must generally use the accrual method. Step 3. Consider your business type. Service businesses and small retailers often benefit from cash accounting's simplicity, while businesses with inventory typically need accrual accounting. Step 4. Evaluate your cash flow patterns. If you invoice clients with payment terms, accrual accounting provides a more accurate financial picture, though cash accounting offers simpler tax reporting. Step 5. Assess your record-keeping capabilities. Cash accounting is simpler and requires less sophisticated tracking, while accrual demands detailed accounts receivable and payable records. Step 6. Consider your growth plans. Fast-growing businesses may benefit from accrual accounting as it provides better financial insights and is often required for obtaining loans. Step 7. Review the tax implications of each method for your specific situation with a tax professional. Step 8. Once chosen, get IRS approval to change methods by filing Form 3115 if you need to switch later. Don't forget to like this video and subscribe to our channel.